Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Donald Trump is at war with the Federal Reserve, and it is glorious. Last week, Treasury Secretary Bessent ridiculed the Fed as a, quote, universal basic income for academic economists, suggesting any organization that makes this many catastrophic mistakes needs a, quote, fundamental reset. Bessent highlighted the Fed's keeping rates too low for too long under Biden, which gave us 30% plus inflation, their comically bad predictions on tariff inflation, their capital rules that privilege mega banks at the expense of community banks, and the Fed's pockmarked record on financial crises, which Bessent likened to a, quote, hazmat cleanup team that doesn't prevent the crisis in the first place. Meanwhile, the Trump administration has now progressed from mean tweets about Jerome Powell's IQ to mounting calls for an investigation over Powell's handling of a $2.5 billion renovation of the Fed building. For perspective, that's about 7 times the cost of the stadium for the Colorado Avalanche for renovations. The renovations matter because there's a beautiful little clause in the Federal Reserve Act saying that a chair can be fired for, quote, cause. Now, cause legally includes ethical breaches, gross negligence, and even incompetence. $2.5 billion for new curtains probably ticks that box. Of course, none of this is really about curtains at the Fed. It's about Jerome Powell keeping interest rates high despite low inflation under Trump, whilst Powell gave Biden sweetheart rates despite double-digit inflation. In a recent video, I mentioned this is a century-long pattern for the Fed: sugar for Dems, whips for Republicans. In raw numbers, since the Fed's founding, Democrats got 0.7% real rates, which is almost free money, which creates an economic tissue fire, while Republican presidents get 3.1% real rates, which is about what they are now. Even the Fed's cheerleaders are starting to urge Powell to resign to protect the Fed's structural independence, including probably the most influential bond market analyst, Mohamed El-Erian. Their fear is the longer Powell stays, the angrier Trump gets, and the more likely a fundamental reset clips the Fed's wings for good. The irony, of course, is the Fed gets clipped either way. If Powell resigns to preserve Fed independence, the resignation itself is the end of Fed independence. Now, Trump probably has the authority to fire Powell if they run with the renovations as negligence. Toss in the threat of criminal prosecution, and Powell may decide the potato is too hot and leave on his own. So what's next? For now, Trump is downplaying firing Powell. Prediction market Kalshi has just 23% odds of Powell exiting this year. In fact, you could argue it's better if Powell stays because a president who hates the Fed is more likely to gut it, take away its powers. Of course, the ideal is Trump pulls an Andrew Jackson, abolishes the Fed, and replaces it with nothing, retiring the trillion-dollar money printers and the Wall Street bailouts and leaving monetary policy to markets, which ends the inflation recession cycle that feeds Leviathan at the expense of our fair republic. Kalshi's actually running 12% odds that Trump, quote, ends the Federal Reserve, so it is not science fiction. And say what you will, Trump is known for doing wild things when he's angry. The worldwide tidal wave of populism just hit Japan, with a tiny Japan First party started by a random YouTuber coming number 2 in last week's upper house election. Is it time for MAJA? The election cost Japan's long-dominant LDP their majority for just the 3rd time since 1955. So last Sunday, Japan went to the polls to fill half these seats in their Senate. It was the highest turnout since 2010, driven by voter anger at the current government, with recent polls showing just 21% approval, narrowly edging out dysentery. The issues were the economy and immigration, which fueled right-wing parties at the expense of both the ruling party and the fractured left-wing opposition. Now, Japan's inflation is currently running almost twice the rate in the U.S., while economic growth is running 0.0%, that's a rounding error to recession. Food inflation in Japan is up 7% year-on-year, driven by a weak yen and government deficits, but rice prices are up 100% thanks to regulatory straitjackets. TV shows in Japan are now showing people how to cook rancid rice so it tastes okay. Japan's wages are plunging. The average wage in Japan is now just $14 an hour. That's not minimum wage, that is average wage in a developed country. In fact, Japan's wages are lower than they were 35 years ago. Keep in mind, this is all before Trump's tariffs fully hit exports. So the economic clown show was fuel to a second big election issue, immigration. Japan's political establishment is run by big corporations. Basically, think of a country run by Mitt Romney. The corporations have gotten a taste for third world wages, importing now millions of third world migrants. Yes, even in Japan. Japan's foreigner population doubled since 2015, hitting almost 4 million. Go into a 7-Eleven in Tokyo now, and there's a good chance these staff are Indian, which is something you never used to see. Now, this all drives wages down. The starting salary at 7-Eleven Japan is now $8 an hour, which is probably a great wage in Bangladesh. Meanwhile, Japanese media is feasting on widespread rapes and violent crimes by third world migrants, including a brawl by over 100 Kurds at a hospital near Tokyo. So the economy and migrants drove a massive shift to right populists, especially the Sansei To party, started by a random YouTuber who wants to restore power to the emperor, is unapologetically nationalist, which is long a taboo in Japan. He wants women to quit work to have more kids and wants the emperor to take more concubines to set the example. Interesting for bond markets, he also wants the government to ramp up welfare spending despite Japan's national debt that in U.S. terms is roughly $71 trillion. So going by Sunday's vote, he is now the second largest party in Japan. So what's next? For now, Japan's ruling LDP will limp along, but if they keep 21% approval, they're going to hit gridlock and will have to call an election. If last Sunday's results hold, Japan could take a huge swing towards populism. Japan's financial system is already teetering on crushing levels of debt, basically an upside-down pyramid, and anti-corporation, anti-bank populists could tip it over the edge. That would lead to a fire sale of Japan's mountain of American debt that would send our interest costs soaring, so say hello to $3 trillion deficits, and it would bring Wall Street cap in hand for yet another bailout. A word from our sponsor. If you own gold or silver, you know they're a great hedge against financial instability and let you grow your wealth outside the banking system and gain greater control over your finances. Monetary Metals offers you the ability to increase your precious metal ounces every single month. Instead of paying to own metal, with Monetary Metals, you get paid 4% on your gold paid in more ounces. Now's the time to secure your wealth and build your legacy in an asset that the government cannot inflate away. Join thousands of investors earning interest in physical gold and silver every month with Monetary Metals. Visit monetarymetals.com/Peter to learn more. Now back to our show. Europe just got, quote, eaten for breakfast by Donald Trump in a shockingly one-sided trade deal that has European officials and journalists crying in their tax-funded cognacs. French officials describe it as a, quote, dark day, an act of submission. The Financial Times of London called it a, quote, steamroller. One European CEO mumbled, "I'm embarrassed to be European today." Bloomberg called it, quote, brutal, adding that the European Union needs some serious soul-searching how it got so weak. So first, what's in the deal? In short, 15% tariffs on almost everything Europe sends to us, 0% tariffs on almost everything we sell them, and a commitment by Europe to buy $750 billion of American energy, to invest $600 billion into the American economy, and commitments to buy, quote, hundreds of billions of dollars in U.S. military equipment, buy, not gifts. The energy alone would triple American energy to almost two-thirds of Europe's energy imports, replacing the Middle East and, of course, gray market imports from Russia. In fact, it's so much energy that American gas companies are scrambling to build the extra capacity. Meanwhile, the $600 billion investment would roughly double European investment in the U.S., and targets will be energy, defense, and industrial production. In other words, stuff Europe used to be good at. In both cases, if Europe drags their feet, tariffs pop back to 30%. So the background is 3 weeks ago, Trump sent the EU a so-called tariff letter threatening that unless they cut a deal by August 1st, tariffs will go to 30%. Europe blinked. Why? Because Europe exports nearly $600 billion a year to the U.S. taking just half in return, meaning roughly 5 million jobs were at risk in Europe, concentrated in their manufacturing powerhouse Germany, which is already shrinking going on 2 years thanks to green energy and environmental regulation. Now, given Europe's economy has been flirting with recession since COVID, 5 million would almost certainly cost Europe's left-wing leaders their jobs, likely replaced by nationalists who want to deport the criminals who are the future of Europe's left. The larger issue is how Europe got so fragile that they can't say no to a gangster-level trade deal. Nice economy you got here. In short, Europe's socialists gutted their own economy. One study from Morgan Stanley estimates almost half of the innovative companies driving global economic growth are in the U.S. Europe has just 10%. Germany's GDP per capita is lower than West Virginia. France is lower than Mississippi. Portugal and Greece are poorer than Puerto Rico. Europe is quickly turning into Mexico with Soviet speech laws and more riots. So as sex, Europe has been a parasite on America, both militarily and economically, cashing in on the American market while closing their market to us. 15% tariffs will start to even that up, but it could also tip Europe into recession. The EU itself was already expecting just 0.9% economic growth for the year. The trade deal could drop that to half a point or less, which will feel like a recession to Europe's angry voters. Those voters will get a chance to share their thoughts in the coming year with elections in Germany and Italy later this year, and increasingly populist Portugal and Netherlands soon after. European socialism delivered West Virginia wages, if not Puerto Rican, third world public safety, and it's turned Europe into a punching bag. European voters are losing their patience. The AI winter is coming for the finance bros, as a new Bloomberg survey finds 300,000 finance jobs could be at risk from AI in the next 5 years. Cue the world's smallest violin. Now, this should not be a surprise considering there's a lot of IT jobs in finance, and layoffs in both IT and finance are rising twice the rate of the rest of the economy. And the reason, of course, is programming is ground zero for AI. A programmer with AI does what 10 used to. Doge, for example, was a couple dozen whiz kids armed to the teeth with AI. Meanwhile, a new study from immigrant cheerleader BlackRock predicts countries that reduce immigration will best weather the coming AI job slaughter, so much for needing mass migration. The 300,000 number comes from a Bloomberg survey of 92 major banking groups, where they found mass layoffs coming from the next big thing in AI, agentics. So agentics is an AI that can actually do complex tasks like financial planning, supply chain management, and marketing campaigns. For example, you could ask it to search the entire state of Texas for houses selling 20% below Zillow estimate and automatically put out a bid. Or, of course, you could ask it to identify $55 billion in crony government payments. The impact will be huge in finance and real estate, which employ about 9 million white-collar Americans. Now, I've mentioned in previous videos that the net impact of AI on jobs will depend whether it's easy or hard to create new jobs, to start a business or expand and hire existing businesses. Because AI, like all automation since horse and plow, makes all wages go up, it's like an escalator where you step down as your job is automated, but the automation itself makes the new job or the new gig pay a lot more. So consider that a bartender in the US makes 20 times what he would in Cambodia, not because he's 20 times better, but because the US is much more automated than Cambodia, where you dig holes with shovels. Still, we can't just assume the jobs. A lot of job barriers are government red tape, mandates, and of course taxes that take the fun out of starting a business and put a big wedge between what it costs to make something and what customers will pay. And that all brings us to BlackRock's study on immigration. In a recent interview, BlackRock CEO Larry Fink said that countries with restrictive immigration, like Korea, Japan, and China, will do best with AI job losses. Now, this should be obvious. Importing millions of low-skilled workers when your own low-skilled workers are being automated is a recipe for disaster. Still, it is progress coming from Open Borders BlackRock, and it suggests yet another Trump effect, as one by one, the establishment shakes itself out of the collective hallucination that importing the third world was a good idea. So what's next? In 1870, half of Americans worked on a farm. The mechanization of agriculture wiped out those jobs, and it made us rich. If we make it easy to create jobs, then AI and robots will be our tractors. They'll free us from the drudgery of today's world where, according to Pew, half of Americans hate their jobs, which is not how it's supposed to be. Of course, the road from here to utopia is paved with hundreds of thousands, if not millions, of lost jobs, apparently starting with the finance bros. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. The Doge Superbots are coming for the federal regulations. They could wipe out 100,000 useless and illegal mandates shackling our fair republic. Will we be able to open lemonade stands without on-site OSHA coordinators? The Washington swamp was very relieved when Elon Musk went back to catching rockets with chopsticks, while Congress famously took Elon's trillions in federal Doge savings and squeezed them into a travel-sized $9.1 billion in cuts. But one big legacy of Doge had nothing to do with spending. Instead, it targeted the regulatory leviathan the deep state has weaved into a straitjacket on the American economy made of hundreds of thousands of bureaucratic rules and mandates. The National Association of Manufacturers estimates red tape adds $25,000 in costs per worker. For small manufacturers, it's $50,000, as in regulations cost more than salaries. EPA permits alone can add decades to infrastructure or factories to the point companies walk away. You may recall Biden trying to outlaw pizza ovens or succeeding in redefining puddles as waterways to wipe out family farms. Drive through a small American town and what used to be mom-and-pop restaurants and charming bed and breakfasts is now a gas station, a Burger King, and a Howard Johnson, thanks to regulations. Then there's the inflation. So regulations add an estimated $94,000 to the cost of a new house. They nearly double rents. Regulations drive up meat costs by a third, milk by a fifth. They tack hundreds of dollars on new appliances. In healthcare, they give us $1,000 Band-Aids and $1 million transplants. So what Doge did is they built an AI tool that analyzed over 200,000 federal regulations and mandates to determine which ones are not, in fact, legal, as in the law either expired or they never were legal. They found that roughly half were actually legal. That's 100,000 rules. They estimate costs us $3.3 trillion per year, which is more than the income tax. In fact, it's almost the GDP of Japan. It's actually even worse. Doge found just 4 in 10 federal regulations are legal. Another 12% are not exactly legal, but they're, quote, needed by the agencies, raising the question perhaps agencies should stop doing illegal things with illegal rules. So far, the bots rewritten over 1,000 rules at HUD, which was the test case. Took them 2 weeks to do that. Now it is devouring the other 99,000 rules. So what's next? Tax and spend gets the headlines, but regulation is even more important for growth. One Mercatus study estimated that if regulations had simply been frozen at Reagan levels, family income today would be $30,000 higher. You can only imagine if we had gotten rid of 100,000 illegal rules in 1980, perhaps 6 figures would be a normal income now. During his first term, Trump removed 5.5 rules for every new one. During the campaign, he promised 10 to 1. Doge could take that to 1,000 to 1, which would create millions of jobs and trillions in wages for the American people. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersaintange.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.